Well, a very good afternoon, good morning. Welcome to HYCM's Look Ahead webinar with myself, Giles Coghlan. Although it says the workshop, this is the Week Ahead webinar looking to the major economic data points that we have coming up. I hope everybody is well. Don't forget, as we're looking at different entries, exits, the whole point of this webinar is you look over my shoulder, see how someone from a professional analyst and trading perspective goes about analyzing the markets. So we will be looking at the major economic data points that are due. And of course, it's the Bank of Japan meeting on Wednesday. A lot of speculation surrounding what the Bank of Japan are going to do. We're going to cover that so you can see what all the fuss is about, as well as the potential opportunities that there may be as speculation increases that the Bank of Japan may be about to exit their ultra loose monetary policy. I do hope everybody is well and that you can see my screen and hear my voice okay. Hopefully that's all coming through a-okay. So any issues with that, please do let me know. Everything seems to be working fine my end. So good to have you here. Welcome those of you who have just arrived. Very nice to have you and looking forward to the session ahead. So without further ado, let's look what's going on. So let's just sort of give ourselves a little recap. It's a bit quiet to stay in the markets because it's Martin Luther King Day in the US, so we're expecting quite muted and relatively mild price action in US markets during this holiday. So we can see US equity futures markets just pulling back for some sort of major resistance level trend line approaching here in the S&P 500, just a little bit of a pullback, nothing particularly to know. China's 50 continues to surge higher. That's on the good news that although there were 60,000 deaths sadly in China due to COVID, there is expectations that severe COVID hospitalizations, although high, have potentially peaked. So that's just helping the exit from COVID narrative, just giving China's 50 stocks another big boost to the upside. The US stock markets are continuing to gain after last week's inflation data. Now I just want to run through with you what's going on here. If you look at the expectations for the Federal Reserve hiking interest rates, what you can see is that the Federal Reserve are expected to cut interest rates twice this year, according to short-term interest rate markets. So that's investors looking at the US economy and the US policy saying, oh no, the Federal Reserve will have to cut interest rates twice this year. That's why we've been seeing this weakness in the dollar, and you can see the dollar weakness has been carrying on over last week in expectations that the Fed's going to have to cut twice, right? And we can see the dollar just cutting down through this key support, now turning resistance line. We're not reading anything into the moves today because markets are away on holiday and it's just a bit of a digestion of what happened last week. So which narrative is right is obviously what investors are trying to work out. Now, if you just take a look at the core inflation rate from last week, it was good news. It was good news for those that see interest rates peaking because core inflation dropped to 5.7. That was expected. That was good news. Headline inflation also fell as well. Then we had the University of Michigan Consumer Sentiment on Friday, and if you take a look at that, that was reassuring as well. The one-year inflation expectations dropped to 4, below the 4.4 that was expected, which is coincidentally the same as December's reading, and that's good news. But the 5-year inflation expectations rose a little bit from 2.9 to 3, and most wise heads say that it's the medium-term inflation expectations that are the most important. So last week, the general narrative was supporting this view of short-term interest rate markets that the Fed will be cutting interest rates twice this year. That's what allowed the dollar to weaken. That's why stocks are generally gaining. That's also been supporting precious metals like gold and silver. You can see gold had a tremendous week last week, surging higher, just seeing a little bit of a pullback today. Silver as well, just pushing up to that key overhead resistance level. Just a little bit of a pullback today, not reading anything into these signs. Oil pulled back last week and saw a strong week of gains after the pullback area from last week, rather. So commodities were generally supported on the inflation as peak narrative. Okay, so that's where we're at. Now, we now have to process that data with this week. Now, this week, it is earnings seasons. We've got Goldman Sachs and Morgan Stanley reporting their earnings today. And then we've got Netflix on Thursday. So yeah, there's some, big bank names, but we've already had earnings from Bank of America last week, and the bank earnings were pretty robust, and financials tend to do well in high interest rates environments because they can charge more for their loans, etc., etc. So not a major focus of the market, so that there are some minor points which I won't go into now. However, Netflix is an important tech stock. Had heavy falls, obviously, after the peaks due to COVID stay-at-home stock status, which really helped Netflix during COVID. Has fallen significantly, but just note this strong seasonal pattern. Now, this is not something I'm trading, and I'm not saying you should trade it, but I just wanted to say, notice the seasonal pattern for Netflix. Around this earnings, remember this earnings period now is the fourth quarter earnings from last year. And notice how the seasonals for Netflix incredibly strong. Average return of 10% between January the 17th and January the 29th. So the maximum gain was 73% in 2013, incredible gains. Now, not expecting anything like that this time, but we could see some, a decent pop higher if the earnings is not as bad as markets are fearing. There's been a string of downward revisions in earnings, as the base case as we start the year is that the US is going to fall into recession. So if it's not as bad as feared, Netflix could have a relief, a relief recovery rally. So just watch out for that, and watch out for volatility in Netflix around this time. So I just wanted to point that out to you. Now let's get into the major calendar data. Today, pretty muted on the calendar, virtually empty for the US side of things. We've got some New Zealand data coming up later for business confidence. Not expecting that to be particularly market moving. If it is market moving, it would be a bit of a surprise. Both the Aussie and the New Zealand dollar have been benefiting recently from the dollar weakness. You can see that here if we just take a look here. Aussie US dollar, New Zealand US dollar, both benefiting from the dollar weakness. And you would anticipate that continuing on. Australian dollar also benefiting from high iron ore prices, as well as the China reopening theme, but nothing to note from these economic data points. Tuesday, we do have some jobs data coming out of the UK and some Chinese data, industrial production, GDP growth rate. Not expecting that to be particularly market moving. The reopening narrative as China cuts back on some of its more stringent COVID measures, the reopening has been boosting China stocks significantly. You can see here the China 50 just been on an absolute rip, and since October's low, you see that China 50 has now gained over 25%. So fantastic opportunity there. This was something I was buying into in these dips, and oftentimes when you have these big dips, that's good opportunities for buying, specifically over the medium term. I've covered this a number of times because look, China's 50, down almost 50% from those 2021 highs. So this value is extremely good, good value. And then we can see you can define risk with this trend line going back above it. Now we're back into the direction we wanted, breaking above that trend line. So any retracements in this level for me seem reasonable for medium-term, long-term buying, and then obviously get back below that trend line, get out. So China's GDP growth rate, retail sales will be eyed carefully. That's a disappointment. We could see some pullback in China stocks, but I'm not expecting that to be massively influential. Why? Because we already know that China's sort of recovering, and the recovery May, although it may be patchy, it still is expected to continue. So a bad data print is likely to probably find dip buyers, and a good data point is unlikely to be so good that it really changes the narrative. Although an outside response to the upside could get more buyers into China's 50 stocks, particularly if you notice this phenomena, that overseas investors have bought the most A-listed shares in China. That's shares that are open to foreign investors since May 2021. Okay, and if you look at that, it's a huge inflow of foreign investment into China. China's become popular again. So if we did get really good data out on Tuesday, that would silence some of the concerns that China's recovery might be patchy. Very minor point, not tradable, not something I'm trading, but just general picture. On the Tuesday, we have Canadian inflation data. Now, this will be interesting, okay? Now, if you just look at the Bank of Canada, current expectations are that there's going to be a move from 4.25 to 4.5. So investors are saying there's a 70% chance of a 25 basis point rate hike from the Bank of Canada. Expectations have been pretty flat recently, and if you just take a look at the CAD index, you can just see that we've seen the CAD pulling back. We were expecting that pullback in the CAD, and now the CAD's been pretty much flat. So in other words, if we see inflation data, that means the CAD, that the Bank of Canada won't hike interest rates by 25 basis points. You could see some more CAD downsides. What would that look like? So what we'd be looking for is this. If we see Canadian inflation coming in like headline, say let's just maximize this out. Say we get inflation coming in, 6.1% or lower. Say we see the trimmed mean, say we have that coming in below 4.9%, and then we have the core coming in below 5.5%. So there's a big miss here in the data. Then that could mean more CAD weakness. So one potential currency to look at could potentially be the CAD yen, depending on what happens with the Bank of Japan later. But expectations that the Bank of Japan are going to be exiting their very loose monetary policy. So those expectations should at least keep the yen bid into Wednesday. So CAD yen could potentially make sense for selling if we had a big miss in the inflation data. And you see markets around that 100 exponential moving average. It could be one to potentially see a little bit more downside in. So definitely watch out for potential CAD yen selling if we saw a big miss in the Canadian inflation print on Tuesday. So we want to see those misses that I've outlined. That's something to look at. We then have some Fed speakers. Look out for Fed speakers. Here's the narrative. We've looked at the narrative, which is if the Fed look like they're going to be, no rate cuts, then this pricing has to reverse, because the Fed are saying there's going to be no rate cuts all year, which is, markets peaking at that 5% and staying at 5%. That's what the Fed keeps saying. But short-term interest rate markets say, no, you're not. You're going to be cutting twice. And that's why the dollar's been weakening. But if we start getting Fed speakers saying the market, you're wrong, we're not going to be cutting interest rates this year, then that pricing has to reverse. So we could see some dollar strength. Now, I don't know what's going to happen, of course, I don't know the future, but that's the narrative to keep your eyes on. And that's what you want to look out with Fed speakers. On Wednesday, the Bank of Japan interest rate decision. This is important. Now, let me just give you the context of what's going on here. So, the latest inflation data out of Tokyo, and this is an important leading indicator for inflation generally in Japan. You can see that that's moved higher, up to 4%, and it's the highest level since 1982. So a huge surge in inflation for Tokyo, which puts pressure on the Bank of Japan for hiking interest rates. Now, the problem with the Bank of Japan is that their ownership now exceeds 50% of Japanese bonds. So the JGBs, they have 50% of them. And this means that the debt level that Japanese government has is very, very onerous. And if yields surge, then this huge level of ownership could result in significant economic strain for Japan. That's why investors are speculating that will Japan exit their ultra loose monetary policy? Will they start signaling that? Now, one of the ways they might begin to start signaling that will be the following. They've kept this cap on the bond yield curve, and they've kept this cap on the 10-year JGBs at 0.5 to minus 0.5. Now, the cap originally was plus 0.25 to minus 0.25, and they kept that cap. Now they've extended it up to 0.5 as a surprise move. They did that last December. And you can see here the sudden surge, right? And it's moved up to 0.5. And since moving up to 0.5, it's actually trying to move higher. Why? Because it's like the market testing the Bank of Japan. Are you really going to defend this level? Will you keep buying bonds? You own 50% of all Japanese bonds now. Are you too at risk to the cost of government borrowing surging? These are the kind of questions the markets love to ask, particularly central banks when they try to pin things at certain levels. And you can see that the Bank of Japan was successful in pinning this level for quite a few years, and now cracks are beginning to show. So if they do, the speculation is, will they extend this 0.5 band up to 1%? Now, if they extend it to 1%, then we'd expect a sudden downside in dollar yen. So you could look at CAD yen, depending on what happens with the CPI data, but dollar yen would obviously be a go-to pair. And technically, if we just look at the dollar yen, we can just see we're above this key overhead, this key support level, which is just coming in around this 125 region, May 2015 highs, also the 100 exponential moving average. So if there is a big shift and they do expand that yield curve, we could look for a move potentially down to that 125 region. That's something to keep on your radar. Now, to be clear, most analysts are expecting no change. Okay, so it's not like the markets are expecting there to be a change on this reading from the Bank of Japan on this interest rate decision, but just to be aware, there could be. Okay, now there could be because of the expectations that have been growing regarding the Bank of Japan and the pressure that they're under with these bonds. So just bear that in mind. We then have inflation data early morning. Now this is important, and there's a different inflation reaction to the pound than there is to other currencies. So if there's a downside surprise in UK inflation, that's pound positive. Why? Because it means a stagflationary picture is less likely. Remember, stagflation, high inflation, and low growth. So that's one thing that's feared for the UK economy. And if CPI comes in lower, say it comes in below 10.2% for the headline, the core, say the core comes in below 5.5%, then that should be pound positive. And so you probably trade that against the dollar, probably pound dollar, or potentially, depending on what the Bank of Japan do, potentially could be pound yen if there's any reasons for yen weakness and the Bank of Japan disappoint, or possibly pound CAD if there's any reason for CAD weakness on the inflation print on the day before. So pound strength if the CPI comes in to the downside, and if it's to the upside, then that will be pound weakness, because it doesn't mean that there's going to be higher interest rates. It means that there's more chance of a UK stagflation. So if this comes in above 10.9% and the core comes in above 6.6%, then we'd expect the pound to weaken, and you could potentially look at pairing the pound with another currency that has any reasons for strength. So it could be a pound yen short if the Bank of Japan expand that yield curve to, to 1% overnight. So just watch out for that. But that's an opportunity. UK inflation data for sure. As is, I want to say US retail sales, but no, I don't think that's necessarily going to be such an opportunity. Now, I did think originally it would be, but I'm not so sure now. And the reason I'm not so sure is just because that the reasons I'm not so sure is because a strong US economy, is it going to change the Fed's outlook? I think it's going to be more an inflation picture than necessarily growth. The growth picture has been good. So if there's a big disappointment to the downside, that could surprise markets, and we'd expect to see the dollar weaken. So a big miss here, I would expect to see the dollar weaken, and that would support gold or silver, but it's not something I'm trading, but I will be just watching it. Fed's Harker coming up, so watch out that, and Fed Logan on the same day, so bear that in mind. Australian employment data, again, Aussie's been quite well supported against the dollar, so dollar weakness helping the Aussie. Also, more positive rhetoric from China helping the Australian dollar, as is iron ore prices. If you just take a look here at iron ore, you can see that surge in iron ore prices just been good for the Aussie dollar. Iron ore is Australia's largest export, so with iron ore prices increasing, that literally just helps the Aussie dollar itself. And if we just go to the Australian dollar index, and if you just overlay iron ore prices across the top, you can just see there's quite a close correlation. So when iron ore prices are rising, Aussie dollar's rising. When iron ore prices are falling, so is the Aussie dollar, etc., etc. So just that relationship is pretty solid, and that's also been helping the Australian dollar. Nothing that I can particularly see tradable for the employment print, so that's just one to be aware of though. And on Friday, let's just have a look. Some more Fed speak, some Canadian ADP data. I do want to see, there is some US PPI data that's coming out. So the jobless claims, okay. There's US PPI data this week. Let me just see where it is. Here it is. Now that's one to look at. Now the reason you want to look at PPIs on Wednesday is because that will give investors an indication of how the Fed is doing and how inflation is going to impact Fed policy. If this is very low, say this comes in, look, so the prior was 6.2% for the core. That's expected to drop to 5.6. That should be negative for the dollar heading into Wednesday. Similarly, prior was 7.4 for the headline. That's expected to fall to 6.8. If that comes in well below market expectations, say 5.2 and below 6.5, then that means that producers are under less pressure and less inflationary pressure. And if a producer's under a less inflationary pressure, then obviously that's much less likely to flow through to the consumer. So producers experiencing lower inflation is good news for the US economy, and that plays into this narrative that short-term interest rate markets have, that the Fed will be able to cut twice this year, and that supports dollar downside and it supports equity upside. So there's a lot of things going on this week you need to be aware of. Should be an interesting week, but then next week should be when it really gets interesting, with more tech names bringing in their earnings. The only thing I would say is just look at the S&P 500 at a pretty major level here. Do you see this trend line? False break, price broke lower, then we had this condensing false break inside bar, price moved higher, tested that overhead resistance, and now we're in a big sell zone. So if there's a strong reason to sell stocks, that's a very attractive area to sell. But wouldn't be surprised to see more dip buying on expectations that the Federal Reserve may be able to not be so aggressive in hiking interest rates, and certainly expectations for maybe slightly better earnings. It's not that earnings are expected to be good this year, but they may not be as bad as investors are fearing. So we could see some dip buying or a little bit of upside into the S&P 500 as we come into the end of next week, middle of next week. So watch out for that. We'll cover it again when we're there. Okay, don't forget on Wednesday we have the normal workshop, and I will be looking at the US retail sales print. I'm probably going to change that. We'll probably look at the CPI print instead. We'll also cover the retail sales print, but I think, although I wanted to do the US retail sales, I think on balance, we will look at both, but I want to focus on the PPI print because that's going to have most impact. And it's slightly out of the reaction that University of Michigan consumer sentiment print, which I found a little bit of not confusing as such, but it was a little bit surprising the way markets reacted. So I think I want to shift that and have a look at the PPI print on Wednesday. Okay, folks, thank you all very much, and look forward to being here on Wednesday. Thanks everyone now. Goodbye.